This share-based payments. So yesterday we discussed about the share-based payments, and we started with equity settled transactions. So normally in case of equity settled transactions, we'll be considering two major things: whether the transaction is related with employees. If it is related with employees, then we need to consider the fair value of the equity instrument on grant date. And if it is other than employees, then first we should see whether we can measure the fair value of the goods or services reliably. And if it is not possible to get the fair value of the goods and services reliably, then we'll be going with the fair value of the equity instrument on the grant date. Now, normally, these expenses and equity should be recognized on the vesting conditions. Now, vesting conditions can be like service-based conditions. So, first we discussed about the service-based conditions, where that particular employee need to serve for a company for a specific period of time. And we also discussed an illustration where we recognize the expense and equity according to the vesting conditions. So we discussed it this and all this. So I hope the discussion is clear. So any queries up to that particular point? So before I go with the performance-based conditions, let me know if you have any query. Okay. So next, in these vesting conditions, there will be performance-based conditions also. Now we try to understand what is this performance-based conditions. Now generally these performance-based conditions depends upon two elements. What is market-based performance conditions? Just a second, please. So here these performance-based conditions will be market-based performance conditions and non-market-based performance conditions. So market-based conditions are nothing but here related to the share price. Now normally in order to exercise the share options, so here the main point is it depends upon the share price of a company. Now let me give an example. X Limited company issued around 1,000 shares to Y Limited company. Sorry, X Limited company issued 1,000 shares or share options to their employees, and on a condition that in order to vest or in order to exercise the right on, in order to exercise the right on that, the market price of the company need to reach. It means the company need to get the share price of the company need to reach at least some specific price. So X Limited, when they issued shares to the employees, the condition here is in order to exercise that particular share option, the share price should be at least a specific price. Here the condition is $5 per each share. This is known as market-based condition. Now, in case of service-based conditions, we learn that the employee need to serve for a specific period in order to exercise the option. Now, in case of market-based conditions, a company share price need to receive nothing but a specific price to be received. The company market price, a specific share price, the company share need to achieve. Because there is a logic also here. Now, what is the purpose of giving shares or share options to the employee? So the main object is to convert the individual obligation into organization object, because they want employees to work for the organization. So their object, it means in order to create more interest among the employees to maximize the value of the company, generally they will be issuing the shares or share options. So here the condition is that in order to exercise that particular option, in order to like whatever shares, suppose if I receive 10,000 shares from my company, and if I want to exercise those particular share options, exercise in the sense if I want to sell those shares, there is a condition that the company market price should be at least as I mentioned, $5 or $10. Now, these kind of conditions are known as market-based performance conditions. Now, non-market-based performance conditions are nothing but achieving a specific sales target. It means employees can exercise the option if the company sales achieves a specific target. So employees can achieve it if the company achieves a sales of 50,000 or whatever the limit is there. And other non-market based performance conditions like achieving a specific earning per share or achieving a specific net profit, these are non-market based performance conditions. Once again, I repeat, performance conditions are nothing but here the employees will get the right on those equity or share options when a specific criteria are satisfied. If it is a market based, the criteria will be achieving a specific price for the share, and non-market based performance conditions are nothing but like earning per share of the company, and it can be like sales of the company, right? So it may includes two also. Now, generally, when the company issues the share options, it will be a combination of it can be a combination of service conditions as well as the performance based conditions. It can be both, or some companies only prefers to go with only service conditions, and some companies may go with service conditions as well as performance based conditions. Now, I believe you understood the difference between market-based performance conditions and non-market-based conditions. Is it clear? Are they non-market performance? Yeah, yeah. No service. No, it won't come under performance, right? Once again, I repeat, service conditions is not performance. Performance in the sense the performance of the company. Service is nothing but the service, the minimum service period an employee need to work. Okay? Yeah. So this is the thing. And here, whenever you found these market-based conditions, now if there is any market-based conditions, now you can completely ignore that, because whenever the fair value of the share option is computed, in that case, the market-based conditions, or it means the in that fair value, these adjustments will also be complete. In simple terms, if market-based conditions are given in your case, you can completely ignore it. Now, the reason why we need to completely ignore it, when this fair value of the share option is determined, in that case, already this change will be adjusted. Now, let me show this point. If you see, the market-based conditions have already been factored into the fair value of the equity instrument at the grant date. So because it is already factored in the fair value of equity instrument, so therefore an expense is recognized irrespective of whether market conditions are satisfied. So it means you need to recognize the expense irrespective whether the market-based conditions are satisfied or not. Now let me take an example. See, here there is an illustration. On January 2001, 100 employees were given 50 share options each. Now these will vest if the employees still work for the entity on 31st December 2002, and if the share price on the date is more than $5. So try to understand, on January 2001, 100 employees were given 50 share options each. Now these will vest if the employees still work for the entity on 31st December 2002. And if the share price of the date is more than $5. Now, January 2001, the face value of the option was $1. The share price on 30th December 2001 was $3, and it was considered unlikely that the share price would rise to $5 by 31st December 2002. Now, 10 employees left during the year ended 31st December 2001, and further 10 are expected to leave in the following year. Now, how should the above transaction be accounted for in the year ended 31st December 2001? Now, here try to understand. On January 2001, 100 employees were given 50 share options each, and these will vest. Here, just try to understand the condition. These will vest if the employees still work for the entity on 31st December 2002. Now, what kind of condition is that? Is it a service-based condition or performance-based condition? This will vest if the employees still work for the entity on 31st December 2002. What condition is that? Service-based or performance-based? Because here they mentioned it as the date. The employee need to work up to 31st December 2002 in order to vest these share options. So it is a service-based condition, right? And they also gave, and if share price on the date is more than 5. So two conditions are there. One is service-based condition, that is up to 31st December employee need to work, and the next one is these shares will vest if the share price on the date is more than $5. Yeah, it is market-based perform, nothing but market-based performance conditions. Now, what IFRS 2 says is, whenever this market-based condition is given in the question, no need to show its effect, nothing but no need to consider this. No need to consider this. Why we should not consider this? Let me show this point. Because it says that market-based condition have already been factored into the fair value of the equity instrument at the grant date. Market-based conditions have already been factored into the fair value of the equity instrument at the grant date. So therefore, an expense is recognized irrespective of whether the market conditions are satisfied or not. Now let me explain this, because they mentioned that the employees can exercise this only when the share price reaches to $5. On January 2001, the fair value of the options were $1. It means the fair value of the option on the grant to date, what is the fair value they considered for the option? $1. The share price on 31st December 2001 was $3. This is very, very important. The share price on 31st December 2001 is $3, and it was considered unlikely that the share price would rise to $5 by 31st December 2002. It means for the year ending, the share price is $3, but at the grant date, they decided the fair value of the option as $1. Now, this $1 includes, it means it is factored, the market rate factored into this. So that's why you can completely ignore the market-based conditions. Now, here, what will be the expense, participants? Can anyone let me know how much expense we should recognize in this case? Total 100 employees. Each employee is getting 50 share options. So, and by the year 31st December 2001, 10 employees left during the year, and further 10 employees are expected to leave in the following year. So, what do you think? How much we should recognize? What should be the expense which we need to recognize? 100 into 50, 0.8 divided by, okay. What is this 0.8? 100 into 50 is correct. 100 into 50 into, you should take the fair value 80% of the employees. Okay, 10, yeah, 80 employees. Okay. Then you should also take the fair value. The fair value is missing here. Anyway, the fair value is only $1. Here you can see the fair value of the option is $1. So the amount which you get, that will be recognized as expense. Should I show it in Excel sheet? One second. So 100 into 50 into 80, 80%, or you can also take like this 100 into, see, instead of 80% directly you can do, because they mentioned that 10 employees and further 10 employees are going to leave. So directly from 100 also you can deduct total 20 employees. Out of 100, 20 employees are going to leave. 10 employees and expected to leave another 10 employees in the next year. So 20 into each employee is going to get 50 into the fair value of the option is 1 into 1 divided by 3. So the total 2000 will be recognizing it as an expense. So here you can observe we completely ignored this market based condition of $5, because while computing the fair value of the share option, this market price, this market condition will be factored. So completely you can ignore it. So the expense which we need to recognize is 2000. So let me know if you have any query on this. Clear? So equity expense will show, this 2000 will be showing in statement of profit or loss account, and same 2000 will account it as equity. Exactly. When you are computing this value, so this particular, when you are computing the fair value of this option as $1, this includes, this market condition is already factored here. So the same point mentioned here. Market based condition have already been factored into the fair value of the equity instrument at the grant date. So therefore an expense recognized irrespective whether the market conditions are satisfied or not. So this point you need to remember. So if possible, please try to make a note of it. Very important. Okay. Shall we go with the next TUI on this? Now, on January 1, 2004, an entity that is Blueberry granted share options to each of its 200 employees, subject to a 3-year vesting period, provided that the volume of sales increases by a minimum of 5% per annum throughout the vesting period. So a maximum of 300 share options per employee will vest, dependent upon the increase in the volume of sales throughout each year of the vesting period. And they gave some information. If the volume of sales increases by an average of between 5% and 10% per year, each eligible employee will receive 100 share options. Then, if the volume of sales increases by an average of between 10% and 15% per year, each eligible employee will receive 200 share options. And if the volume of sales increases by an average of over 15% per year, each eligible employee will receive 300 share options. Now at the grant date, Blueberry estimated that the fair value of each option was $10, and that the increase in the volume of sales each year would be between 10% and 15%. Now, it was also estimated that a total of 22% of the employees would leave prior to the end of vesting period. Now, at each reporting date within the vesting period, the situation was as follows. So here they gave some reporting date, that is 31st December 2004. Employees leaving in the year is 8. Further leavers expected prior to the vesting date, they gave it as 18. Annual increase in the sales volume 14%. Expected sales volume increase over the remaining vesting period 14%. Average annual increase in sales volume to date is 14%. And similarly for 31st December 2005, employees leaving in 2005 is 6, and further leavers expected prior to the vesting date is 4. An annual increase in sales in volume is 18%, and expected sales volume increase over the remaining period is 16%, and average annual increase in sales is 16%. Now at 31st December 2006, employees leaving the year is 2, and the annual increase in sales volume they gave it as 16%. Now participants, please once go through the question, just try to understand what is given in the video. Please once go through it. Then we'll have a discussion on this. So once done with the reading, please let me know. Yes. So first they granted total granted share options to each total employees is 200. Now here 3-year vesting period. So the service based condition is 3 years. And in addition to these service based conditions, provided that the volume of sales increases by a minimum of 5% per annum throughout the vesting period. It means employee, in order to vest these share options, there should be a minimum increase in the sales by 5% per annum. Now, what kind of condition is it? Is it market-based performance condition or non-market-based performance condition? Yes, it is non-market-based performance conditions. Very good. So here they mentioned that in order to vest these particular share options, there should be a minimum increase of 5% per annum, and a maximum of 300 share options per employee will vest depend upon the increase in the sales. So it means if the company sales are between 5% to 10% per year, if the sales are increasing by 5 to 10%, then each employee will receive 100 share options. Similarly, if the sales are between 10 to 15%, then each employee will receive 200 share options. And if the volume of sales increases by an average of 15% per year, then each employee will receive 300 share options. Right? So this is the on the basis of increase in the sales, the number of share options are also given. So minimum 100 in order to at least in order to get 100 share options, minimum 5% increase should be there. And they also mentioned that at the grant date, very important point, at the grant date, this Blueberry estimated that the fair value of each option was $10, and that the increase in the volume of sales each year would be 10% to 15%. At the grant date, Blueberry estimated that fair value of each option was $10, and that the increase in the volume of sales each year would be between 10 to 15%. On an average, it will be 10 to 15. So it was also estimated that the total of 22% of the employees could leave prior to the year end of the vesting period. Now, at each reporting date within the vesting period, the situation is as follows. You can see these particular conditions. So first we'll compute for 31st December 2004. So for 31st December 2004, so calculation. Yeah. So how many employees we need to take? Actually, total employees are 200. Total employees are 200. So for 31st December 2004, how many employees we should consider? Out of 200, 31st December, we are expecting that employees leaving in the year is 8. And further employees expected to leave is 18. So it means 200 minus 8 minus 18. I hope this is clear, participants. 200 minus 8 minus 18. And how many share options they will be getting? Because the expected the annual increase in the sales for 2004 is 14%. So how many share options they will get? If it is 5 to 10, they will be getting 100. 5 to 10, it is 100 name. Yeah, it is 200. So 200 into the grant date share option is $10. Here you can see 10 into 1 divided by 3. So we got it as 1,16,000. So we'll show expense 1,16,000. Then we'll show equity 1,16,000. So let me know if you have any query on this. Is it clear for 31st December 2004? So below this, just I'm showing how we got this 1,16,000 so that you can see 200 minus 8 minus 18 into 200 into 10 into. So this is the procedure how we got this. So shall I assume that the 31st December 2004 is clear? Yes. Now next one, 31st December 2005. So what will be the computation for 31st December 2005? 200. In that already first year, how many left? 8. Then second year, we are expecting that 6 employees are going to leave. Then next year, we are going to expect 4. So 200 minus 8 minus 6 minus 4 into how many share options they are going to get for 2005? Because annual sales increase is 18%. Yeah, very good. 300. Yes, if it is more than 200 means, if it is more than 15% means 300. So just I'm showing the computation here. So 3,64,000. In this 3,64,000, already we recognize 1,16,000. So the expense would be 3,64 minus 1,60,000. So we recognize 2,48,000 expense and 3,64,000 as our equity. So this is for 31st December 2005. Then 31st December 2006. So for 31st December 2006, so total employees 200 minus first year already 8 employees left, second year 6 employees, and last year 2 employees. Into how many share options? Because 31st December 2006 annual increase in the sales is 16%. So it will be 300. So we got 5,52,000. In that already 3,64,000 is recognized in the previous year. So the expense part would be 5,52 minus 3,64. Then the equity will be 5,52. So any query for all this for this? To see the computation, let me know if you have any query. Yeah. Now the accounting treatment for the vesting condition. It means on the vesting date, what will be the accounting treatment which we should consider? So that we will be discussing. So we try to discuss with a small illustration. So a beginner offered directors an option scheme conditional on 3-year period of service. So the number of options granted to each of the 10 directors at the inception of the scheme was 1 million. Then the options were exercisable shortly after the end of the 3rd year. Upon the exercise of the share option, those directors eligible would be required to pay $2 for each share of $1 nominal value. So the fair value of options and the estimates of the number of options expected to vest at the vesting point in time is given below. So start of the year 1, rights expected to vest is 8 million and fair value of the option is 0.30. End of the year 1, rights expected is 7 million and fair value of the option is 0.33. End of the year 2, rights expected to vest is 8 million and fair value of the option is 0.37. At the end of the year 3, 9 million rights actually vested. So show how the option scheme will affect the financial statement for each of the 3 years of vesting period and show the accounting treatment at the vesting date for each of the following situations. So they gave the fair value was $5 and all the eligible directors exercised their share option scheme immediately. Fair value of a share was $1.5 and all the eligible directors allowed their share options to lapse. So first we'll go with the requirement E. So the requirement A is show how the option scheme will affect the financial statements for each of the 3 years of the vesting period. So we need to show the expense as well as the equity for 3 years. So how we can go with this participants? How we can compute this? Let me show. That is for end of year 1. So end of year 1, they clearly mention rights expected to vest and fair value of the option is also given. So first, how many rights are expected to vest at the end of year 1? 7 million. So rights expected to vest is 7 million. And what is the fair value? What should be the fair value of the option? Do we need to consider 0.33? Because standard says that always we need to consider the share option, nothing but the fair value of the option on the grant date. So what will be the share option which we should consider? They clearly mention the start of the year 1. So start of the year 1 means what is the fair value? 0.30. So it will be 7 into 0.30. So we will recognize expense 2.1, equity 2.1. So I hope end of the year 1 is clear, participants. Yes. Is it clear for the end of the year 1? Because end of the year 1 rights expected to vest is 7 million and the fair value is 0.30. Now end of the year 2. So end of the year 2. So here number of rights expected to vest is 8. Same fair value, there will not be any change, 0.3. It will be 2.4. So the expense which we should recognize is 2.4 minus the previously already we recognized 2.1. So 0.3 and equity will recognize it as 2.4. And end of year 3. So they mentioned total rights expected is 9 million. 9 into 0.30. So we'll recognize 0.3 in the expense and 2.7 as equity. Any question on this? So just you can see this option with A and let me know if you have any question. Clear? Yeah. So let's move to the bit B. Yes. Show the accounting treatment at the vesting date for each of the following situations. So the first requirement is the fair value of the share. The fair value of the share was $5, and all eligible directors exercise their share options immediately. So whoever eligible directors are there, they exercise the share options immediately. So what will be the accounting treatment for this? So first we'll go with first. So they mentioned that all the eligible employees, all the eligible directors exercise their share options immediately. They exercise the share options immediately. So at the end of the year 3, how many share options are vested? 9 million. And if all these 9 million share options were exercised, how much the director should pay? Here you can see this. Upon exercise of the share option, those directors eligible would be required to pay $2 for each share per one nominal value. So it means the company will receive a cash, that is 9 million into 2. So total 18, right? So have we got 18? Because if all exercise, nothing but if all the rights of 9 million, here the total rights is 9 million. If all these are exercised by the director, how much each director will be paying for each share option? 2. So 9 into 2, it will be 18 million. Is that clear, participants? Yeah. Now the second one, already here you can see this is 2.7, whatever the total share options which will be equity. We already recognize an equity of 2.7. Now let me show this one. Is share capital. Now how much share capital will recognize here? Because the nominal value of each share is only $1. So the total shares are 9 million. So share capital will recognize it as 9. Then for 1 million, actually directors eligible are required to pay $2 for this. But the nominal value is only 1. So remaining amount we generally show it as share premium. So the share premium amount would be how much? There is a difference of 1. Here you can see this. I hope you understood this, what I'm trying to explain. The cash is total 9 million. In that 9 million, each share option value which you consider is $2. So total we received 18. But actually the share capital amount is only 9. Why we are taking the 9? Because the par value, the nominal value is only $1. So that's why we need to account 9 into 1. Clear? So the remaining amount will be considered as share premium. $2, $1. Any question, participants, on this? Yes. Any query? Now the second one, they mentioned it as the fair value of the share option was 1.5. Just try to understand the concept. Here, on the vesting date, employee need to pay fair value of $2. But in market, it is only 1. Let me show this. In market, it is only $1.5. In market, if the share option is available for $1.5, as an employee, will you exercise your option for $2? Definitely not, right? So the fair value of the share option was 1.5 and all the eligible directors allowed the share options to lapse. So whenever there is a lapse, whatever this 2.7 which we recognized in equity, we will be transferring it to the what is this retained earnings. So here in that case, we'll write it as revaluation surplus 2.7. We'll transfer it to retained earnings. So this will be the accounting treatment. Because there is no, because you won't be receiving any cash, because if the market value is 1.5, definitely as an employee they won't exercise a share option by paying 2 rupees. Is that clear, participants? Any question? Yes. Yeah. Now, if there is any planned modifications to the terms on which equity share instruments are granted. Now, here an entity may alter the terms and conditions of share option scheme during the vesting period. Suppose it might increase or reduce the exercise price of the option. So the price that the holder of the options has to pay for shares when the options are exercised. Now this makes some less favorable or more favorable to the employees. So it might change the vesting conditions to make it more likely or less likely that the option is vested. In simple terms, there might be a possibility that these conditions of the share options might change. So in case of any modifications, so here how we need to account for these equity settled transactions. So the entity must continue to recognize the grant date fair value of the equity instrument in profit or loss unless the instrument do not vest because of a failure to meet a non-market based conditions. Now, in simple terms, if there is any modifications, these are the very important points which are to be considered. If the modification increases the fair value of equity instruments, if the modification increases the fair value of the equity instrument, then we need to recognize an extra expense. An extra expense must be recognized. So the difference between the fair value of the new arrangement and the fair value of the original arrangement at the day of the modification, we need to recognize in the profit or loss. And the extra expense is spread over the period from the date of change to the vesting date. So that extra expense should be spread from that particular date of change to the vesting date. Very simple. It might look confusing, but very simple. Let me show this. So an entity grants 100 share options to each of its 500 employees, provided that they remain in service over the next 3 years. So the fair value of each option is $20. Now, during the year one, first here we need to understand an entity grants 100 share options to each of its 500 employees. So the condition, they need to remain for 3 years in the company. So fair value of each option is 20. The fair value is 20. Now, during the year one, 50 employees leave. The entity estimates that a further 60 employees will leave during the year 2 and 3. At the end of the year one, the entity reprices, very important point. At the end of the year one, entity reprices its share options because the share price has fallen. So the other vesting conditions remaining unchanged. At the day of repricing, the fair value of each of the original share option granted before taking the repricing into account was $10. Now the fair value of each reported share option is 50. So during year 2, further 30 employees left, and entity estimates that a further 30 employees will leave during the 3 years. Now, during these 3 years, a further 30 employees. So, very, very important point. The fair value of each option is $20. At the end of the year one, the entity reprices its share option because there is a fall in the share price. So the other vesting conditions remain changed. At the day of the repricing, the fair value of each of the original share, the fair value of each of the original share options are is granted before taking into repricing into account was $10. The fair value of each repriced share option is 50. Now, what you need to understand? So, how we can go with this? Because whatever the increase is there, that should be spread throughout the year. Now, let me show this. So, first end of the first year. So, end of the first year, total number of employees 500. And how many employees are going to leave? So, during year one, 50 employees leave. Entity estimate that further 60 employees will leave during the next 3 years. 500 minus 50 minus 60. Into each shareholder is getting 100 share options, and the fair value they gave it as 20 into 1 by 3. I don't think you have any query on this. So expense which we will be recognizing is 260. Now end of year 2. So as it is, first we'll take now end of year 2. So during the year 2, further 30 employees left, and the entity estimates that further 30 employees will leave during the year 3. So 500. First year already 50 employees left, and second year we are expecting 30 employees and further 30 employees. Into number of share options 100 into 20 2 by 3. So let me know whether you have any query till now. So any query up to now? Now here at the end of the year 1, entity reprices its share option because the share price has fallen. So other vesting conditions remain unchanged. At the day of repricing, the fair value of each of the original share options granted before taking repricing into account was 10. The fair value of each price share option now it is 50. Now there is an increase of $5. Now this particular thing should be spread across the next 2 years. So whatever increase is there, that should be shown in the next 2 years. So here we need to show incremental Now, how to compute this incremental for the second year? It would be say 500 minus 50 minus 30 minus 30 into 100. Here we need to take 5. because there is an increase of 5. And this spread across the remaining vesting periods. Now we have only 2 vesting periods. So that's why 1 divided by. So we got 97,500. So 97,500 and equity also. So after adding the incremental values, the final value 2,60,000 plus 97,500. Similarly, equity will be 5,20,000 plus 97,000. Is that clear? Considering the incremental. Any question, participant? Is that clear? Now, end of year 3. So it will be first 500 minus 500 minus 50 minus 30 minus 30. So our expense would be 7,80,000 minus 5,20,000. So equity would be 7,80,000. Then same for this also we need to compute the incremental. Now the incremental value would be minus 50 5. So 1,95,000. So I hope you understood this incremental value 97,500 per second year. Now we got 1,97,000, 1,95,000. So for the expense 1,95,000 minus 97,000. So same value we got. So the total expense which we will be showing same 3,57,500 and the total equity 7,80,000 plus 1,95,000. So this is for modifications. Any question? Any query, participants, on this? Yes. Kathy, any query?
So,
Yes.
just taking you back to the TYU5, here we took it in decimals in the calculation, like 2.7 and 1.6 and all that. So we can also do the same what we did here, right? I mean, taking the number of years, 1 into 3 or something.
You are saying about this one, 2.7?
Yes. Yes.
You can also do like this. Yes.
Like the first year that
Because
was
here
at
in this case,
2.1.
Kathy, what happened in this case is directly they gave the share options expected to vest. So that's why we took like this.
Okay.
So here they already gave, suppose if I take end of the year one, they already gave this 7. Now this
Right.
7 is nothing but this particular part.
Okay.
This one up to now. This one.
Right.
Okay.